The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. US stocks close in the red. The Dow posting its fourth straight down day as investors look to today's key US inflation print. President-elect Trump's pick for Treasury Secretary Scott Bessent gives a short-term vote of confidence to Fed Chair Jerome Powell, but casts doubt on whether he will be reappointed.
As the president said on Sunday, and I am in complete agreement with him, that Jake Powell will serve out his terms and leave the building as Fed Chair on May 26th.
Shares in US Steel slump after a report that President Biden will block its takeover by Nippon Steel when the decision is referred back to him later this month. And who's next up the ramp? Well, who knows? France's President Macron holding talks with political leaders, but excluding the far right and far left. Sounds like familiar territory, doesn't it? As he looks to name yet another new prime minister by the end of tomorrow.
We were debating earlier in the week whether these markets had run out of some momentum, whether some fatigue was starting to set in after what has been a fairly heady run for stocks. And you can see as a result, we've got a very similar pattern to a day earlier where major boards were in retreat. So the Dow were falling by about 1/3% and similar size declines across the charts. Big moving names, the catalysts in the moves to the downside, just giving you some news flow here. And you may recall that it was only about 24 hours or so earlier, we were talking about some weakness in the Chinese data, imports, exports, that impacted the European markets yesterday, but it also fell across on those US boards. Some of those so-called China proxies are weighing up the demand story. And as a result, we had Caterpillar moving to the downside for the Dow. For the S&P 500, another big story here, which was Nvidia. That was the big moving stock to the downside for the S&P 500 and for the NASDAQ. This on the back of the regulatory probe by the Chinese around antitrust for that big semiconductor stock. So today we roll across to the macro side, and we're waiting it up for the CPI news, just what that looks like and what it means for the entrenched view on the market that we are setting up for a rate cut into year end from the Fed. So the 2-year Treasury, we're 4.16. You can see we're elevated across the board on the Treasuries. Bond yields 4.23 at the 10-year. As a result, the dollar. This is the greenback trade versus many of the pairs and crosses against euro dollar. We are seeing again further strength in the greenback, and also for cable, sterling giving back some territory. Dollar yen a little bit weaker, and this has been one of the trades a lot of market watchers are calling for next year, some sort of strengthening of the Japanese yen. And in fact, we're also looking at what the BOJ will be doing in terms of hiking rates potentially into year end. So that is one to watch for. And you can see the other big one, dollar Swissy, it is showing some gains this morning. The Asian markets, well, we did see yesterday market reaction to the weak trade figures out of China. Today, a little bit of move to the upside for the Chinese market. Kospi also breaking out of what has been a downbeat trade on the back of the events that started with the martial law that the president resorted to. So many events and twists and turns since then, but the market has been on the back foot today, finally seeing some upside. The other major boards are Hong Kong's weaker, and you can see it as a flat whole day for the Tokyo stock market, Steve.
Just reading a terrific Politico article, actually, about the real reason why Trump won't fire Powell, apart from the fact there's a small matter of the law, which is in this article, which says you can't remove him unless for cause. But the other reason, why don't I leave you on tenterhooks for the Politico article, and I'll come back to it in a moment. President-elect Donald Trump's pick for Treasury Secretary Scott Bessent has told this channel that Federal Reserve Chair Jerome Powell will be able to finish out his term. Okay. Bessent's comments come amid mounting speculation over the fate of Powell's position following Trump's victory. Well, two things here, or three things here. One, Trump already said this the day before on Meet the Press, of course. Two, you can't fire him because it's against the law unless they've got due cause. And three, and this is the point of the article, the stock market. And it makes the point, and this article is, I'll just give a shout out to the journalist, what the heck, written by Victoria Guida over at Politico. And the point is the stock market. Last time Trump considered getting rid of him back in 2018, the market tanked and didn't like it as well. Trump must acknowledge that Trump uses one barometer of success is how good you look on telly. Another one is how good the stock market is on the back of what you do. And the stock market likes what Powell's doing at the moment. End of.
Rewind to a clip from a few weeks back from a very good media organisation. Oh, it was CNBC. We were talking about the impact on the bond market, where there are some concerns bubbling away about the accumulation of debt stateside. And the one extra layer on top could be, if there is any removal of Powell, that could be the event that would just spike the yield on the 10-year. That could be the extra catalyst on top of the market. So that is one to watch as well.
Yeah, I mean, for all his disdain of Powell, he did put him in the post, which we seem to forget sometimes. Attention turns to today's CPI print, the last inflation report. Well, it's not really last inflation, it's the last CPI report. We've got the PPI on Thursday. Anyway, before the Federal Reserve's policy meeting next week. Analysts are expecting a November reading of 2.7%. That is up from 2.6% on the previous month. Traders, as you all know, are pricing in a more than 85% chance of another 25 basis point cut at next week's policy meeting, Karen.
Let's push on to Matthias Scheiber, who joins us now, head of multi-asset solutions at Allspring. Thank you so much for joining us today.
Thank you for having me.
I want to ask you about the business cycle, because what we've seen right now is that a market keeps on extending and pretending that we've actually got an economic growth story that's going to keep on going forever. And there have been arguments from some of the major institutions, the likes of BlackRock, saying this time's different, we're not getting peak and trough, but we've got other big arms here for the business cycle to be extended. Do you agree? Should we look at this business cycle differently?
I mean, it probably, and you're right, it looks more like a mid-cycle adjustment rather than a recession that we're going to face in the US, right? Because if you look at the growth data, they have been very stable in the US, even as the Fed started to cut interest rates. The labor market started to gradually weaken, but from a very strong position, right? And what we have seen lately, if you look both at inflation and at rates, and if you think of inflation, it's like your quality of your growth, and your rates is your financing of your growth. Actually, inflation hasn't really gone up. So that means they're bringing fiscal policy into a slowing economy. So that's why we could see, and we see that in high frequency indicators, we see a potential re-acceleration of the US economy into next year.
Interestingly, in some of the data, small businesses were now starting to feel quite confident. And I wonder whether that's just a lagged effect. You've had a lot of big businesses looking at deregulation prospects under Trump and tax changes. They're feeling great. Is the small business indicator now just a lagged effect behind those large businesses? Or is there genuine feeling there that there is something to trade around small businesses too?
I mean, there's definitely optimism. You're absolutely right, the optimism around that. Also, if you think of it, a lot of his policies will be US focused, right? So it should help the small cap. They're less getting into the crosshair of any tariffs. And obviously, they also largely benefit from lower rates. So that combination of loose monetary and loose fiscal policy should be very supportive for small caps.
Matthias, very nice to see you. Thank you for joining us. I'm always a great believer in, while the market's looking over here, something else is going on over here, that is the next thing. It's almost Rumsfeldian, the known known or the known unknown, i.e., everyone's obsessed by Trump, tariffs, interest rates, and probably NVIDIA valuation. Is there something else going on that's actually more intuitive about what we should be looking at next? Because the thing that we're all aware of very rarely is the next crisis.
Yes, I mean, that's true. I mean, you could still see geopolitics, right? It's still a big unknown.
Hard to trade geopolitics.
I mean, you can look at on the Trump policies, because one of his, beyond the tariffs and the taxes, is the role of the US in the world going forward, because he has a lot of bargaining power if you think of the Middle East and the Ukraine, right? So if he brings these bargaining chips on the table and he brings one way or other some ceasefire, you could see actually quite a big impact on asset prices.
Well, you just made a fascinating point about US foreign policy going forward, about Republican attitudes to America first going forward. And actually, I see a policy which looks pretty isolationist to me, i.e. a US which is trying to disentangle itself from the Middle East, a US which is trying to unentangle itself from events and military presence in Europe and obviously Ukraine as part of that as well. That, unfortunately, could actually reopen the way for other major world powers to fill that vacuum as well, as we've seen when the Western powers have pulled out of Africa. Who's stepped in? The Chinese. Who have dominated the resource accumulation there? The Chinese as well. So I hear what you're saying, but is that a policy that is fraught for US trade going forward. If you pull out and create a vacuum, the Chinese fill that gap.
Yeah, I mean, they definitely, and I believe they are aware of it. Think of what's currently happening in Syria, right? This is actually a great...
And it looks like the Russians will keep their bases, which is extraordinary diplomacy on the Russian front.
Yes, but they definitely lost some political influence in the Middle East, right? And everyone else in the Middle East who have been a partner of Russia will look at this and say, okay, they have not been able to support Syria because they were way too stretched in Ukraine, right? So, and the US, yes, they will be self-focused, but they will also recognize if I sort out the Middle East, I have a cheaper oil price, I have lower inflation, it helps my economy through lower inflation, right? So that there are all kind of side effects where it still makes sense also geopolitically. If I want to
see, again, this I'm going to go down another rabbit hole in this one. A lower oil price equals a lower gasoline price. It's actually about gasoline he cares about. He wants a $2 oil. They would love a $2 gasoline price as well. But that's a disaster for US manufacturers. It's not great news for Exxon, for Chevron, who have spent so much money in the last 12 months buying extra assets in the Permian.
I mean, definitely. I mean, they are big exporters, but at the end, he will care about the US consumer. It's like with the tariffs, right? The tariffs will be focused more on capital goods and not on consumer goods, because those are the guys who vote for him, right? That's the guys we will look at. The energy companies,
aren't they?
But they will benefit from relaxation of regulation, right, of all kind of other things where the energy companies can benefit. So I have no worry that the energy companies won't benefit from any Trump policies.
So we mentioned China in a geopolitical context, but what about from a monetary, a fiscal side? Because China has pledged big this week that it still has a huge ambition to fix the economy, but yet we're still wading through very tough data signals, and the trade data yesterday again impacting various parts of the international equity market. Do you think China is going to be able to stabilize the economy anytime soon?
I mean, they probably need to change their strategy a bit, because just making money cheaper doesn't work, right? Because no one has a demand for the money. If the stock market is down, the property market is down, you can make the money as cheap as you want. There is no demand for it. So you can create as lot supply as you want. You have a demand problem. You need to come in with massive fiscal stimulus. Just watch the 10-year in China. It's still falling and the yield curve is flattening. You would expect a steepening of the yield curve if they're really successful in what they're achieving.
I was talking to a guest yesterday about perhaps one of the motivations of the Chinese machine is trying to bolster the stock market, which would improve the wealth effect of many of the Chinese. And I did think that many weeks ago it could be one of the ideas, but it does seem dangerous because that is hot money, it's speculation, and people are going to take their money in and out of the stock market. That can cause all sorts of fluctuations. So do you think that is one of the ambitions of the Chinese machine, trying to stimulate the stock market to try and bolster spirits?
Potentially. I mean, we have seen it in Japan as well, right? They bought equity ETFs. So it's not uncommon that the bigger part of the asset base for the Chinese consumer is the property market. You need to take those 40, 50 million flats off the market that are not needed. You need to create like a bad bank, outsource this and take it away from the balance sheet of the local government and free it up for capacity to spend and give the consumer more money on the fiscal side, right?
Matthias, we haven't asked you what your multi-asset solution is for 2025. It's in your title. What is your solution? What should our viewers be doing?
I mean, we still see a lot of demand for people that focus on real return because they believe inflation will be sticky.
So income?
Income.
Hang on, but if inflation is sticky, that means rates remain higher for longer, which means some of the income plays are less attractive.
Potentially, but you still get a decent income, right? If you think of it, you can earn in equities up to 6% income, right? It's not bad. The all-in yield on bonds is good, right? So if you combine it in a multi-asset portfolio, you actually get an attractive income, right?
You're German, yeah?
Austrian.
Oh, well, beg your pardon, sorry. I didn't know, just because I was looking at, I was running my slide rule over a few companies yesterday, and I looked at one thing which I couldn't believe. The dividend yield on Volkswagen is 10%. Well, if this is that looks as sitting duck a dividend yield as ever I've seen one in my life. I mean, quite frankly, they could cut it by 60%. And it'd still be 4%, which is, you know, it's a decent.
Do you think the workers are using that in negotiating tactics?
I think the dividend's toast, isn't it?
So and
that's my problem about some of these income plays.
Yeah, you need to be careful. You can't get to the value
best
trap.
Dividend yields out there are shaky.
Exactly, and there's a reason why they pay such a high dividend yield, right? It's also the same with energy companies, right? There's a risk with energy companies, and they have a less exciting story, but they pay a high dividend, right?
It's fascinating. We could chat to you all day. Oh, we can't. We've got to let you go. Nice to see you.
Thank
you very much indeed for joining us. And are you back in Vienna for Christmas?
Yes.
I spend many Decembers in Vienna over the years, but that's enough of that. I don't do OPEC anymore. It's cold out there, but it's lovely. I love the Christmas markets in Vienna.
Yes, but
the one outside the Rathaus.
Yes, yeah. That's probably the most famous one.
It's amazing. Yeah, well, you mean where all the tourists go?
Exactly. Exactly.
Thanks, Matthias. Nice to see you. Matthias Schäber,
Thank you so much.
Head of Multi-Asset Solutions at Allspring. And there are other great Christmas markets out there, but I do like the ones in Vienna. Karen, have you done that one?
I haven't done the Christmas market, but I have certainly had my Wiener Schnitzel in Vienna before. And it's fabulous. Yeah, I love
I remember the
Wiener
days
Schnitzel.
when I used to eat Wiener Schnitzel.
It's fabulous, isn't it?
Very good.
We've got to push on away from culinary delights to what's coming up. The US President Biden signals he will block a Japanese takeover of US steel. Our colleague Lynn will have the latest after the break. Plus, markets await a new French Prime Minister as Macron sets a 48-hour deadline to appoint someone to the role. We'll have more this hour. And we'll get an update on the green transition with Wärtsilä CEO Håkan Agnevall, who is coming up later on in the show at 8:30 GMT. To the latest in autos, and Tesla sold nearly 22,000 EVs in China in the first week of December, its best weekly sales figure of the fourth quarter. It comes after the automaker posted its best month in China this year, in November, selling more than 73,000 vehicles. General Motors shares rose in extended trade after the automaker announced it will no longer fund its loss-making Cruise driverless ride-hailing service and will fold the unit into its broader tech team. GM pointed to the considerable time and resources necessary, capital allocation priorities, and an increasingly competitive robo-taxi market as reasons for abandoning the project.
Well, happy days for Tesla. The European Parliament's largest political group is reportedly mounting a campaign to water down the bloc's plans to reduce car emissions. It's happening. That's according to Reuters, which cites a draft paper it says is due for release today by the European People's Party, which counts the European Commission President Ursula von der Leyen amongst its members. I would love to see the lobbying finances. Wouldn't you, ladies and gentlemen? Wouldn't you like to see the lobbying finances that is behind this potential blocking report as well? I'm pretty sure I'd know a few of the names on there. Reuters says the document calls for, here we go, a reverse to the EU's 2035 ban on new CO2 emitting cars in order to allow vehicles of these sales of these vehicles beyond this date. This is the continent's auto sector. Here we go. This is kind of my point. Continent's auto sector faces a protracted crisis amid competition from China and weak demand from EVs. Why have we got weak demand from EVs, everybody, when the Chinese are seeing huge demand? Maybe those same politicians are not putting the conditions in place. Maybe those same automakers have lied about the ability of those cars. Maybe we're not seeing actually enough charging stations. Just chucking it out there.
Is it a rescue mission for Germany? I mean, having spoken to Christian Lindner when he was still the finance minister, and he was saying that the ambitions were too ambitious for Germany. Now we're talking about the ambitions on green being too ambitious for Europe, but particularly for autos.
This is exactly the point. It's not too ambitious for China, but too ambitious for Europe. There you go. You students out there can write big dissertations on why that's the case. Why the Chinese are going gung-ho for electric, but suddenly Europe's getting left behind again. Can't understand why, can you? US Treasury Secretary Janet Yellen has warned tariffs threatened by President-elect Donald Trump on the likes of China, Mexico and Canada could derail progress on inflation. Yellen acknowledged tariffs hold value as a tool for tackling unfair trade practices, but warned the sweeping measures proposed by Trump could significantly raise costs for US households. Proposed tariffs are creating uncertainties for the global shipping industry. Annetta is in Hamburg and has been looking at how the industry will handle the impact of new measures proposed by President-elect Trump. Annetta, I think I know the answer to this, but is Hamburg still the largest port, or certainly port set of facilities in the whole of Germany?
Yes, it is the largest port in Hamburg. It's the third largest in Europe after Amsterdam and, Antwerpen and Rotterdam, I should say. So it is a huge operation here, and it's, of course, of vital importance for the German economy. And the looming tariffs are a concern for the shipping industry. But if you look back at the first year of Donald Trump, we already see a similar pattern emerge. And what they do is front loading. They actually try and ship as much goods as possible before possible tariffs will be enacted. And also freight rates have more or less doubled in this year, especially on the routes coming from China. So it's much more expensive to ship goods. And then Janet Yellen is absolutely right with her warning, because we've seen that in the past that freight rates will be passed on to retailers or car sellers or whatever you want to name it, those guys who are actually selling the goods to consumers. And it will mean higher prices in the end. How much higher prices, we don't know, but there are actually academics who are doing the math, and they're saying that 10% higher tariffs could mean up to 3% higher prices. So that's the elasticity in that equation. If Donald Trump was going down the road as in his first 4 years as president, he would actually take it out on Germany. He hates the trade surplus Germany is having with the United States, and it actually does sit at a record high last year. Germany is mainly exporting cars. More than 30% of all exports into the state are cars, but then drugs are a huge, or pharma products are a huge chunk of the exports going into the States. And if Trump was levying tariffs as he was promising it during his election campaign, trade between Germany and the States could actually shrink by up to 15%. That's what the IFO Institute is saying. So let me bring you back to what we have learned from the first 4 years of Donald Trump. It will be higher, as I said, front loading, and then also trade dispersion. We can look at how trade routes were actually changed, and this could have a longer lasting effect because, of course, the shipping industry is also getting used to different trade routes. So in a nutshell, it will mean higher prices, different trade routes, and probably less activity between the continents.
And Netta, thank you very much for that. Well, shares in US steel fell sharply Tuesday after a Bloomberg report that President Biden will formally block its takeover by Japanese Nippon Steel when it is referred back to him later this month. The White House said Biden continues to believe US steel should be domestically owned, but that the process of considering the takeover is ongoing, while US steel said the takeover should be approved on its own merits. Let's get out to Lynn for more. Lynn, there are so many different threads to unpick here. The fact that steel was a priority for the Trump administration last time round, that conditions are changing as we think about certain assets now having national security connotations. Just walk us through the latest here.
Yeah. Hey, Karen, as you were just highlighting there in the intro here, the CFIUS review is still ongoing, but the base case here is that we have right at the top on both sides of the political aisle opposition to this Nippon Steel takeover. So that doesn't bode well. Now, when we listen to what Nippon Steel executives have been saying all year, whether that's in earnings calls, whether that's in AGMs, they've always been saying that they believe this will get through after the US election because cooler heads would prevail effectively. But we are now in that post-election phase, and this is the situation here. But certainly it isn't completely over. So we are still waiting for that CFIUS review. We did hear from Nippon Steel today in a pretty strident defense, of course, of this buyout. They said that they are looking at all options on the table. They said that politics shouldn't, quote, continue to outweigh true national security interests, that they have been engaging in good faith, and that in their view, this takeover bid, it makes economic as well as national security sense, especially in the, I guess, backdrop of a more assertive Beijing. Now, in terms of Other things we could be looking at is indeed if this takeover bid is blocked, we could see a legal challenge. Although I did speak to a cross-border M&A lawyer today who said to me that it's unlikely that any kind of challenge could get up in a US court with a presidential decision, especially because the next president is also opposed to it. And then I guess the broader implications here for Japan, we have seen that in the data, it has consistently been number one in terms of foreign direct investment into the United States. What kind of message is that sending to Japanese corporates on that front? And then also, is this really just a one-off, given some of the idiosyncratic aspects of this story, or is this a sign of a broader pattern to come, especially as we've seen, of course, United States, which has been the leader of globalization, of free trade, moving more and more towards protectionism.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.